Okay, let's unpack this. For anyone who's been following the cutting edge of decentralized finance, you know there's this problem that feels almost impossible to solve.
Right.
How do you get that institutional-grade privacy, but at the same time also ensure full public auditability? You usually have to pick one or the other.
And that's why we're doing this deep dive. Today we're looking at ZEROBASE, or ZBT. It's a decentralized cryptographic network that's trying to do both.
Exactly.
And this isn't just another DeFi project. It's aiming to build a whole new foundational layer for Web3 by creating what they call verifiable off-chain computation.
Okay, what does that actually mean?
Think of it like a guaranteed private mathematical receipt for any complex calculation. It's designed to close those fundamental trust gaps that, keep traditional finance on the sidelines of crypto.
So they're trying to offer the best of both worlds, total secrecy and total proof. How do they pull that off without, resorting to magic?
Well, it's a pretty powerful technical synthesis. They're blending two established heavy hitters in the cryptography world. First, you have zero-knowledge proofs, or ZKPs. That's the pure mathematical proof that a computation happened correctly. Then they use trusted execution environments, or TEEs, which are basically specialized hardware-based security chambers where the sensitive computation actually happens.
So the math proves the result and the hardware proves the security of the process itself. That actually makes sense.
Exactly.
So our mission today is to pull apart that hybrid architecture, explore how it's fueling their flagship product, staking, and we have to talk about the severe security turbulence that hit the project in late 2025.
We do, because despite having, arguably the best security tech available, the market delivered a really brutal reality check.
A huge reality check.
But you have to see that against the backdrop of serious credibility. The project was co-founded by Mirror Tang. He's a respected cryptography professor and the CEO of Sales Security. They got $5 million in seed funding.
Right.
And even with all the controversy, their main product, Zk staking, grew to over $400 million in total value locked TVL.
400 million.
That number alone tells you that institutional players and, serious capital, they trust the core promise of the system.
Okay, so let's jump right into that architecture. Why the complexity? Why do you need both ZKPs and Ts? If the math proof, the ZKP, is already solid, why bother with expensive specialized hardware?
It's all about solving what people call the black box problem, especially for regulated institutions.
Okay, give me an example.
Imagine a hedge fund. They have a complex proprietary trading strategy. They need an auditor, maybe a regulator, to verify that their risk calculations were sound and their profits are real. But they can't show their competition their secret sauce.
Right. They want to prove the result without revealing the inputs.
Exactly. The T provides that secure, hardware-isolated little room, the enclave, where the calculation happens privately. It keeps the input safe from everyone, even the person running the node.
And then the ZKP.
Then the ZK proof is the immutable mathematical receipt that verifies the outcome on-chain for the whole world to see. It's verification without visibility. That is the institutional unlock.
It's a powerful model. But for this to be viable, for business, it can't be slow. Traditional crypto proofs can take ages.
And that's precisely where they've invested. ZBT isn't just about theoretical security, it's about commercial scale. The network is engineered for high performance, aiming for millisecond-level proof generation.
Milliseconds.
Yeah, we're talking 200 to 400 milliseconds at a cost of less than a single cent per proof. That kind of speed and low cost is what makes it usable for high-frequency finance.
And to get that speed and that hardware isolation, you can't run this on just any old laptop, I assume.
Absolutely not. The proving nodes, the ones doing the heavy cryptographic lifting, they need specialized hardware, specifically advanced Intel Xeon scalable processors that use features like SGX or TDX.
The specific Intel chips.
The names aren't that important. What's important is that these are hardware features designed to create secure, tamper-proof memory areas, the enclaves. It's a hardware guarantee that the private inputs are processed securely and hidden from the server operator.
Okay, but hang on. If the network is demanding that every proving node uses specific Intel hardware, doesn't that immediately introduce a point of centralization? You're relying on a single manufacturer. It seems to undermine the whole decentralization promise.
That is a crucial question, and it's a trade-off. ZBT acknowledges it. For now, to guarantee that super stringent T security and the millisecond performance, they have to rely on specific tested hardware.
So for them, security trumps decentralization, for now at least.
For them, the priority is verifiability and security for those big institutional use cases. They argue the network itself is still decentralized through its coordination model, even if the individual computer parts are specified.
So talk us through that coordination model. How are they routing all of these high-speed proofs?
They use a scalable architecture they call a hub-prover coordination model. To manage the load, they use a consistent hashing algorithm.
Which is just a fancy way of saying they route proofs quickly to the nearest available proving node.
Exactly. It's all about efficiency. And this setup achieves a confirmed throughput of 7,000 to, get this, over 8,300 transactions per second, just for generating ZK proofs.
7,000 proofs per second is huge. So if I wanted to run a node, what are the incentives? What are the requirements for these two different roles?
They're very different, and it shows some really strategic thinking on their part about stability. The proving nodes are the high-security workhorses. Because they're at the core of proof generation, they're backed by mandatory stablecoin collateral, usually USDT or USDC.
Wait, stablecoins, why not use their own native ZBT token for collateral? Most projects do.
And that's the key insight. They want network security tied to reliable value, not speculative crypto prices. If security relied on ZBT, a sudden price drop could just destabilize the whole network's trust layer. By demanding stablecoins, they shield the network's reliability from ZBT's price volatility.
Smart. You rely on stable value for your critical security. What about the other nodes?
Then you have the hub nodes. They're less demanding. Their job is just routing proofs and sharing bandwidth. They earn continuous ZBT emissions for that, but they don't need that massive stablecoin collateral.
Okay, so this whole sophisticated hardware network, it needs extreme reliability. So the question becomes, how do you build a token to incentivize that? Let's get into the engine room, the ZBT tokenomics.
Right, so the ZBT token is the fuel. And it's important to note how it's classified. It's a MiCAR-compliant utility token. That proactive regulatory move is huge, and the token itself has a fixed total supply of 1 billion.
A fixed supply is one thing, but how is it distributed? How do you align the team's interests with the long-term success of the protocol?
They put network security first. The biggest chunk, almost 44%, is for node staking rewards. Basically paying the network keepers.
And the team.
The team and advisors get 20%, but they face a really strict vesting schedule. A minimum 1-year lockup, followed by a 48-month linear vesting period.
A 4-year vest after a year-long lock. That is a serious commitment.
It's the market signal that matters. A 48-month schedule signals that the core team is incentivized for the next half-decade, not just the next quarter. It builds confidence that insiders aren't just going to dump the token.
So, besides rewarding node operators, what drives the core utility and, the actual demand for ZBT?
Well, first, it's the currency of the network. You have to pay in ZBT for the cryptographic proving services and the bandwidth. So more use means more demand.
Yeah.
Second, governance. ZBT holders participate in the ZKDAO and vote on protocol parameters.
And they need a lot of people to agree, right?
Yes, major proposals need a 15% quorum to pass, so the community has to be actively engaged. And third, it funds ongoing ecosystem incentives for developers.
They also built in a way to make the token more scarce over time, to link success directly to the token's value.
Yes, and this is strategically important. They have a deflationary pressure mechanism. The DAO governs a buyback and burn program, and this program is funded by 20% of all protocol revenues.
20%.
Which means as their high-yield financial products generate fees, a portion of that money automatically buys ZBT off the market and removes it from circulation forever. It directly links network activity to ZBT scarcity.
Let's talk about that network activity. How are institutions and users actually using this thing right now? The centerpiece is obviously Zk staking. You mentioned it exploded to over 400 million in TVL.
Zk staking is the perfect showcase for this idea of verifiable CeDeFi. A user deposits stablecoins, like USDT or USDC, and earns yield from these sophisticated risk-neutral arbitrage strategies run by professional finance groups.
So you're getting institutional-style returns, but the whole thing is transparent.
Precisely. It creates a regulatory moat. The proprietary hedge fund strategies, the how, they stay private, protected by the T's, but the core risk parameters, the final profit and loss, that's all verified with ZK proofs and recorded on-chain.
So you don't need to trust the fund manager, you just trust the math.
You trust the math. And then, in November 2025, they pulled a huge lever with The super strategy. This is where that token burn mechanic really kicks into high gear.
This seems to be the single biggest driver of ZBT demand.
It is. The super strategy is this highly exclusive quant trading product. To even get access, you have to buy and burn CBT tokens.
Burn them, not stake them.
Burn them. They call them tickets. Anywhere from 1,000 up to 100,000 ZBT. And the amount you burn determines your deposit limit. And the lure was undeniable. They were claiming returns of 99.83% annualized.
I had to read that figure twice, 99.83%. I mean, that number is a giant flashing red light in traditional finance.
Of course. But it's the exact lure that drove massive engagement and, critically, that token burn. It links the success of the high-yield product directly to ZBT scarcity.
It creates this internal cyclical economy. You want the high yield, you have to burn ZBT. That burn reduces the supply, which theoretically increases the token's value.
Which then makes it more expensive for the next person to get in. It's a powerful flywheel.
So beyond this financial engine, what other kinds of privacy apps are they building?
They have a few others targeting broader Web3 use.
Yeah.
There's ZLogin, which is fantastic for digital identity. It lets you verify yourself with Google or Apple without exposing your personal data or linking your social identity to your public crypto wallet.
You prove that you're logged in without revealing who you are.
Exactly. It's a huge privacy upgrade. Then there's ZK Dark Pool, which is a confidential trading protocol for DX. It's designed to stop front running by hiding transaction details. And finally, they're moving into the consumer space with Proof Yield, which is supposed to launch in Q4 2025 and let people monetize idle computer resources.
Okay, this is where the whole story pivots. We've established that ZEROBASE has this potentially groundbreaking cryptographic and hardware security. It's designed for institutional trust. But despite this seemingly impenetrable foundation, the project faced a massive security crisis in December 2025. What happened? What went wrong?
It was a monumental failure of the human layer. It completely bypassed all the perfect math and the hardware isolation. It was a classic Web3 nightmare. A sophisticated front-end phishing attack.
Phishing?
Yep. Attackers targeted users who were interacting with the Binance Smart Chain interface. They got them to sign malicious contract approvals, and they drained over $250,000 in USDT from user accounts.
So all that specialized hardware, all the ZK proofs, the core protocol was fine. It was never touched.
Wasn't assailable.
But a simple malicious website linking to a bad contract address stole $250,000. That's genuinely shocking.
It's a profound lesson in Web3 security. This breach included one devastating single loss of $123,000 from one user. It perfectly illustrates that even if your underlying cryptography is flawless, the user-facing interface, the website where people click approve, is still a critical, vulnerable attack vector.
What was the immediate fallout? You can't have a breach like that and expect the market to just shrug it off.
The market reacted instantly and harshly. Binance Wallet quickly blocked the malicious domains. ZEROBASE deployed automated detection systems, but the confidence was just shattered.
And the price?
ZBT's price fell over 21% in 1 week. The token just spiraled and was soon trading 90% below its all-time high of $1.13, which had been set just 2 months earlier.
A 90% drop. It just reinforces that in DeFi, community trust is arguably more valuable than any line of code.
Absolutely. The problem wasn't the math or the hardware. It was the accessibility layer. They solved the hard computer science problem. Now they have to solve the easy human problem.
And we should mention, this was all happening while co-founder Mirror Tang was having to publicly address a prior team dispute and clarify the project's financial ties to Binance Labs through his other company.
Right. They were fighting a war on two fronts. Fixing an external security failure while shoring up internal trust, right when confidence was at its absolute lowest.
So looking forward, how does the team plan to restore that confidence and scale up? What's on the immediate roadmap?
The focus is on decentralization and expansion. For governance, we're about to see the launch of the fully decentralized ZKDAO governance module. This puts full voting power into the hands of DBT holders. It's a classic move to restore trust by giving the community more control.
And scaling that huge throughput we talked about.
They're actively upgrading their global hub nodes to push throughput consistently past that 7,000 TPS mark. And more importantly for users, they're planning a pretty aggressive cross-chain deployment for ZK staking.
So taking it to other chains?
Exactly. Moving on to major Ethereum layer 2s like Arbitrum and Optimism, and also Polygon in the first quarter of 2026. This will massively expand their potential user base.
You know, I found their proactive regulatory strategy really insightful, especially for attracting that institutional capital.
That's a key differentiator. The issuer, this company Vortex Tech in the Cayman Islands, they didn't wait. They proactively filed a MiCAR white paper in July 2025. This officially classifies ZBT as a utility token under Europe's new crypto regulations.
Which is a huge green light for institutions.
It signals that they are serious about integrity in regulated environments. If a bank wants to use your infrastructure, they need that kind of clarity.
And finally, what's the long-term vision here, beyond just DeFi?
Their ultimate ambition is to move beyond just proving financial transactions. The goal is to expand the proof network into a standardized infrastructure layer for what they're calling verifiable AI.
Verifiable AI.
This is where they would cryptographically prove that AI outputs think medical diagnoses, financial forecasts are authentic, haven't been tampered with, and were generated by a verified process. It's a huge vision.
So what's the core lesson for us here? I think the key takeaway is this sharp, painful tension between ZBT's genuinely groundbreaking capabilities, the millisecond proofs, the institutional potential, the high-yield engine, versus the persistent, real-world risk of a simple phishing attack.
To put it simply, ZEROBASE built a high-speed private audit layer for the decentralized economy. They solved the hardest computer science problem, but the security of the whole ecosystem still hinges on protecting users from the simplest scam.
And that leaves us with a final, provocative thought for you to explore. Given how deeply ZEROBASE's proof system is integrated into these high-yield products like the super strategy and the immense economic pressure that creates through the token burn, does that long-term economic necessity of reducing the ZBT supply outweigh the recent catastrophic security deficit when you're deciding on the long-term viability of this token?